Welcome to this earnings call for LIC Housing Finance. We have with us Mr. Vinay Shah, MD and CEO, and Mr. Sudipto Sil, Deputy CFO, to discuss the quarterly results. I would request Mr. Shah to take us through the key highlights of the quarter, post which we'll open the floor for Q&A. Over to you, sir.
Good morning and welcome to the post-earnings conference call of LIC Housing Finance. As you would be knowing, LIC HFL declared its Q1 FY19 results last Friday. With effect from this quarter, that is Q1 FY19, Indian accounting standards is applicable for housing finance companies. Accordingly, our financials have been presented in accordance with the Ind AS, and previous year's figures have also been restated wherever required to present a comparative picture. The key highlights of the results are as follows. Revenue from operations, rupees 4,019 crores as against rupees 3,027 crores for the corresponding quarter of the previous year, a growth of 11%. Outstanding loan portfolio at rupees 1,68,652 crores against rupees 1,47,050 crores as on 30th June 2017, reflecting a growth of 15%. Individual loan portfolio at rupees 1,60,265 crores as against rupees 1,41,439 crores, up by 13.4%. Disbursements at rupees 9,600 crores as against rupees 8,700 crores for the same period in the previous year, a growth of 10%. Net interest income at rupees 980.03 crores as against rupees 919.37 crores, up 7%. Net interest margins at 2.34% as against 2.52% for the same period last year. Profit after tax for the quarter stood at rupees 567.94 crores as against rupees 479.65 crores, a growth of 18.41%. Pursuant to the introduction of Indian accounting standards, companies are required to report expected credit loss or ECL on their loan assets and provisions thereon. Accordingly, the provisions for ECL for the current quarter stands at rupees 160.75 crores against rupees 203.97 crores for the same period in the previous year. The asset classification as per the new accounting standards is now classified as Stage 1, Stage 2 and Stage 3 exposure at default EAD. The quarter under review saw a significant event in the way of beginning of a rate hike cycle initiated by RBI's increase in repo rates after a gap of 4.5 years, followed by another rate hike this month, impacting the wholesale rates as well as retail lending rates. On the business front, we have disbursed about rupees 9,600 crores as compared to rupees 8,700 crores for the corresponding period at a growth rate of 10%. Overall, we have seen good growth from some locations in central, eastern and some part of northern and southern regions of the country. Overall, loan sanctions reflects a good pipeline build up, especially in the project loan category. The loan sanctions in the retail category recorded a growth of 13%, thereby indicating a pickup in disbursement growth in the retail category in coming quarters. On the affordable housing front, under the PMAY CLSS schemes, the company continues to do well. During the first quarter, the company recorded a disbursement of more than 7,100 accounts in this segment as against about 2,000 accounts for the corresponding period of the previous year, with an average ticket size of rupees 18 lakhs. In value terms, the disbursements in this segment grew ninefold to rupees 1,300 crores as against rupees 142 crores in the previous quarter. As a share of incremental disbursements in the retail segment, it works out to 17% in volume and 15% in value terms. You may recollect that the share of this segment in our overall business in FY18 was 11% in volume terms and about 8% in value terms. We therefore continue to be confident of growth in this segment this year as well. As part of our current year's growth strategy, we have opened 24 new marketing offices, which works out to roughly 10% of the existing numbers. Most of the offices have been opened in places where we did not have an outlet, and a large number in Tier 3 and 4 locations. This is the largest branch expansion initiative of the company in recent times and will support its growth plans. During the quarter, we have launched a new distribution channel called Direct Marketing Executives to augment our sales network and to synergize our marketing efforts, especially with respect to projects funded by us. During the quarter, we have also launched a mobile application-based valuation module for faster and better quality assessment of properties and projects funded by us. In terms of asset quality, as mentioned earlier, in line with the NDS, the company has transitioned to the expected credit loss model based on exposure at default. The loss provisions are in line with the historical loss rates of the company, which is one of the lowest in the industry. As a result, the provisions have reduced on a year-to-year basis from 161 crores in Q1 to 161 crores in Q1 FY19 as against rupees 204 crores in Q1 FY18. In my earlier interactions, I had mentioned that we are working resolutely towards recovery of delinquent accounts. I'm happy to share and would like to specifically highlight a recovery of a large builder loan in default, where we had successfully auctioned the underlying asset, recovering the full 100% of the principal amount and nearly the entire portion of the interest. With this, we are confident of more such recoveries in coming quarters. On the retail side, there has been a seasonal increase in NPAs, which we are confident of reducing in the coming quarters. On the cost of funds side, you are aware of the sharp increase on the interest rate scenario and the rate hike cycle initiated by RBI through repo hikes of 50 basis points in 2 tranches. Despite such increases in the system, the company was able to maintain its weighted average cost of funds with a marginal decline of 1 basis points over March 2018 figures through active liability management. During the quarter under review, the overall spreads have shown a sequential improvement by about 10 basis points between March and June 2018. The rate hike cycle has required the company to also review its PLR. The company hiked its PLR by 30 basis points in 2 tranches in April and June. A further 20 basis point hike has also been made this month, making it a total 50 basis point PLR hike, which will be on nearly 1.4 lakh crore of back book and for all the new disbursals. As only a part of the rate hike was during Q1, we expect a larger spread benefit in Q2 and Q3. With this brief introduction, I would like to invite you for your queries. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question-answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We will take the first question from the line of Prakhar Agarwal from Edelweiss Securities. Please go ahead.
Yeah, hi sir. So a couple of questions from my side. First is on asset quality. So, what was the quantum of corporate developer loan that we recovered this quarter? Hello.
Hello. Can you speak up a little loudly, please?
Yeah. So, what was the quantum of corporate developer recovery that happened this quarter?
It was about 40 crores.
So despite that, we have seen some rise in corporate developer book on sequential basis when I look at your gross NPA numbers. So what was the slippages and why was that, which segment, if you could highlight some part of that, for some part on that?
No, actually some small accounts have gone into, but no major account has gone into delinquency this quarter as far as projects are concerned.
Okay, so if I look at your numbers, around 100 odd crores of increase in gross NPA on an outstanding basis on corporate developer side. Now, when I take 40 crores of recovery that has happened, post that around 140 odd crores of slippages would have happened in gross NPA on sequential basis. Was that an impact of Ind AS or something else? Because
some part of it was on account of an Ind AS because of reclassification of assets as per the EAD.
Mm-hmm.
And there has been a recovery, as you have very rightly mentioned. There was a recovery of around 40 crores principal, on which, as we mentioned in the opening remarks, there was also a recovery of almost the entire interest portion on that asset. So there has been some resolution on the corporate loan side as well.
So on individual side also, when I look at your rise in gross NPA numbers, so while sequentially we see on Q1 basis that there is some seasonal impact, but the quantum is relatively higher on that part as well.
See, the quantum partly could be attributed because the base itself has increased. So the amount of increase itself could be reflected through that. But yes, there has been an increase and we are working towards it. There is a seasonality which has also impacted, though the seasonality this time around between March and June as compared to the March and June of the previous couple of years has been a little less as compared to the March and June increase. So it has been a little less, but of course, yes, it is an increase, and as we mentioned, we are working on it. And another thing that can be mentioned here is that if you actually look at post-Ind AS, the actual loss rates, which is mentioned in the, which is basically the ECL on the exposure at default, that has actually been coming down, which reflects the recoverability of such accounts.
And then secondly, when I look at your ECL framework that we're talking about, in terms of outstanding basis, when I look at your stage 3 provisions, which is somewhere close to around 32%, when I compare to peers, it is relatively on a higher side. Anything to read into that as well? So why we have kept on a higher side on that segment?
That is to be slightly on the conservative side. It's an additional buffer, you can say an additional, you can say level of comfort that we have maintained. But if you actually look at it, the recoverability, again, we would like to highlight is very, very high there. Going by the historical loss rates in the company, which has been witnessed over the last several decades, and even as recently as in the last couple of quarters, the actual loss rate is much, much lower.
Okay. And so on margin side, so despite these sort of recoveries that we have seen on corporate developer and 20 basis point of rate hike that was effectively for 2 months that we have seen this quarter, your margins, there was some pressure on that. So why is that so?
It's actually this Q1 fully it has not got translated. The full impact of the 30 basis point will come in fully in Q2. And
was there an impact of corporate recovery that happened through, or there wasn't any? Because
no, see, actually the corporate recovery it will not come in one quarter because after Ind AS it will have to be apportioned.
Okay, so there would not be any impact on margins because of interest income reversals also this quarter?
No, it is not because of that. And actually, if you look at it, there has been sequential improvement in the spreads between March and June. Generally, between March and June, we see a dip. But just to refer to your point, there has been some impact of the rate hike and on the asset side, due to which you have seen some improvement in the overall yields between March and June. And the one hike that we were able to we had done in the month of April, that has given some results. There was another hike which we had done in the month of June. There was absolutely very minuscule impact of that happening in Q1. So the Q1 basically was based upon about a 1.5 month impact of the first rate hike that we had done.
So where do we expect this margins to settle? Any guidance on that?
See, if you look at the total increase in the PLR that has been affected in the first 3-4 months of the financial year to the tune of almost 50 basis points, and this will have an impact on almost 1.4 lakh crores of back book. So that certainly has the impact of pushing up margins, I would say, quite meaningfully in the next couple of quarters.
Okay, thank you so much. I have a couple more questions. I will come back in queue. Thank you so much.
Thank you. We will take the next question from the line of Prashant Podar from ADIA. Please go ahead.
Hi, sir. Hi, Sudipto. Sudipto, just a clarification. So the rate hikes of 10, 20, and 20, they were in. Can you just tell me the exact dates, if it is possible?
Yeah. The first was in April. That was the first hike was in April. The second was in middle of June.
Okay.
And the third was in August, just a couple of weeks back.
So, which essentially means that the whole 20 basis point increase that happened in the end of June, or middle of June, or end of quarter, that had no impact literally for the first quarter.
Yeah, that did not have any impact.
While your costs would have continued to go up, as is visible in your interest expense going up by 12%.
Correct, right.
So from current levels, on a just pro forma basis, your spread should increase by about 20 basis point for the second quarter from the first quarter.
I'd not like to put an exact number to it, but yes, certainly it certainly has that kind of a possibility. Yes.
Okay. Just a clarification on that as well. So this kind of 10, 20 and 20 basis point increase in a very short period of time has not been seen by us for quite some time, particularly in mortgages segment where we expected the industry to be much more competitive. It looks like it has been very sanguine. So can you help me understand what is the competitive, how is competitive dynamics playing out in this segment?
Prashant, this has been, every hike has been done after taking into consideration the competition also. If I can say about the new loans, probably still we are maybe 5 basis points or so lesser than most of the leading companies. Only one of the banks is probably around the same level as we are giving. And back book effect, of course, it'll be there too, as Sudipta said, on the full 1.40 lakhs portfolio.
Okay. One more question on the loan growth itself. Individual loans, not the loan growth, the disbursement growth was pretty muted at about 5-6% for the current quarter, while it also has an impact of Pradhan Mantri Awas Yojana schemes. So if we take that out, it looks like a flattish or a marginal decline in disbursement if some of the fence sitters actually went ahead and got disbursements driven by this particular scheme. What is happening? And if we look at other HFCs or even banks to that extent, the growth rates look slightly better.
Prashant, two things I'd like to say is, number one, if we take the only pure home loan growth rates, that was around 9%.
Okay.
So what happened was that probably some non-core portion gets figured into this, wherein it was showing very less growth or nearly muted. So the overall came to 5%. But if I see the actual home loan growth rate, that is around 9%, the number one.
This is disbursement.
Disbursement. I'm saying about only disbursement.
Yeah.
Yeah. And secondly is, as I said in my address, probably going ahead, we are seeing a good growth in sanctions. Sanctions grew by about 13-14% for the home loan. So going ahead, the new branches that I talked about, we have a very focused attention on them. Our first aim was to open all these 24. It should not linger on for 6 months or so. So all these offices have been opened. They are operational. Business has started. And PMAY also, as I said, our PMAY portfolio, I said the average ticket size is about 18 lakhs. So we are not too much into the lower segment, where the ticket size, very few numbers are there in that. So probably a more this thing will help disbursement growth in the coming quarters. And thirdly, I mentioned about the new channel of DMEs. Those people have been directly targeted to focus on retail loans at the projects where we have financed the developers. So individual loans at those projects will be the responsibility of these particular people.
Okay. Sir, quickly on asset quality, both individual and non-individual. So non-individual is an easier one. It's a smaller book, and despite that one recovery that you talked about, the GNPLs actually have gone up, and I could not understand the technicality behind Indus leading to recoveries happening over a period of time rather than one go.
actually it is...
so you can brief about the recognition of the...
Yeah, recognition. See, actually, earlier, as per the existing NHB norms, the moment account goes into NPA, you stop accruing interest on that. So whenever there is a recovery, you recover the entire amount. There is a reversal and there is a recovery also in one single shot. But under Ind AS, even on the delinquent accounts, you are allowed to accrue interest. And when the recovery actually happens, it does not happen in a lump sum. That is what I meant when I said about the recognition of the interest portion on the this one.
Okay, so to that extent, on the NII, the impact will not be large.
That is right.
But gross NPL numbers would have come down.
Yeah.
Immediately.
Yes.
So again, going back to the previous question, which a person mentioned about, which analyst mentioned about non-individual loans, NPLs going up. If we adjust that, I think that loan was 60-70 crores or so as NPLs.
Total recovery was, principal was 40, total recovery was about 50.
Okay, so reduction of 40 and then there more increase of 100 or more crores. So anything to read into the quality of non-individual loans or any stress in the potential stress in the system that we should be worried about?
No, as such, I think there is nothing exceptional because in the last couple of quarters also we have seen slippages which happen and they get recovered during the year itself. There are some signs of early recoveries also which happen. So as of now, there is no such specific reason, and the methodology of recognizing and EAD, exposure at default, has changed incrementally. So that could also have some impact in the numbers.
So you have 230 live accounts in builder segment, of which how many would be NPLs? Last I remember it was 5-6, which were NPLs.
Big ones continue to be the same.
Big ones continue to be the same. 5 to 6 only, yes.
Okay, but so these 230 are all big, you're saying?
Yeah.
Okay. And in the individual, you said that the seasonality impact was lesser this time, but if we look at on a year-on-year basis, which takes out the seasonality, the NPLs have actually gone up from 0.4% to 0.8%. We have not seen that kind of seasonality in or index impact in any of the other HFCs. If you can help us understand a little bit of that as well and potential recoveries in this segment as well. And that would be my last question actually.
No, Prashant, it has gone up, but as Sudipto said, last year also if we compare March to June, it had shown a 0.35 points basis rise, and current year it is about 0.4. But we are looking into it, and I'm very hopeful that coming quarters this numbers is, in fact, internally speaking, I'm targeting a less than 1% GNPA as at Q2, end of Q2. That's the internal target that has been set, and we have put in a reinforced, in fact, the recovery teams also, and I'm very sure that Q2 is going to be much better.
Sorry, I have one last one, sir. On non-interest income, there is a strong growth of 54%. Is it the things that you talked about in terms of change of fees as well as focused insurance, insuring all your home loans, is it that which is leading to this increase?
Yeah, it is
some one-off.
The fee income which we had discussed in the last couple of calls, that is beginning to derive better incomes.
Okay, all right. Thank you. That's all. Thank you very much, sir.
Thank you.
Thank you. Before we take the next question, I would like to remind all participants, please limit your question to 2 per participant. You may come back in the question queue for your follow-up as we have people waiting for their turn. We will take the next question from the line of Ayush Mehta from LIC Research. Please go ahead.
Good morning, sir. So why have the NIMs fallen this quarter?
Okay, excuse me, can you be a bit louder, please?
Why have the NIMs fallen this quarter?
Yeah, sorry, you're not. Can you please speak up a little loudly?
Hello, Can you
Yeah.
hear me now? Yeah. Why have your NIMs fallen this quarter?
NIMs. Hello? NIMs.
Net interest margin. Yes.
Net interest margin, okay. See, actually, if you look at the net interest margins, you are comparing it with on a year-on-year basis. If you recollect, last year we had actually started reducing our interest rates following there was a lot of I would say competitive intensity. Because of that, in the second half of the year post July, we had reduced our PLR by 20 basis points. So what we are comparing today is the Q1 of last year vis-a-vis the Q1 of current year. Now, once we are able to recover the margins post the PLR hikes, I think the margins will go back to where it was in the previous year before the PLR cuts.
No, but then if the interest rates were reduced last year, then the NIMs should have increased in this quarter, right?
They actually sequentially, at the beginning of the call we mentioned, sequentially there has been an increase in the spread between March and June. But if you compare it with the June numbers with current June numbers, then it has not come up to that level. But between March and June, there has been an increase in the spreads.
So are we seeing an increase in the interest rate now? Yes.
Sorry?
Had the lending rate been increased this quarter?
Yes, we have increased it again in the month of August, which will be in Q2, yes.
By how much, sir?
That is by 20 basis points.
20 basis points. Okay. And so why has your share of LAP increased?
Share of?
Developer loans.
Builder loans actually has remained by and large at the levels of March. It was 4.8, right now it's around 5%. There has been some increase in the builder loans, and we had mentioned in our previous interactions also that post-RERA we are looking at the builder loan segment afresh, considering the better quality proposals which are now coming.
And so what about loan against properties?
They are around the same levels actually, but very, very marginal increase. Yes.
It was 28% in Q1 FY18.
Actually, the LAP, that non-core segment consists of LAP and LRD both. So there has been a conscious decision, and the increase, whatever has come in the LRD. LAP, we have not done much.
Excuse me, Mr. Mohta, this is the conference operator. I'm sorry to interrupt, requesting you to please join the question queue for your follow-up as we have people waiting for their turn.
Okay.
Thank you. Next question is from the line of Dhaval Mehta from Somerset Capital. Please go ahead.
Yeah, good morning, sir. Just a couple of clarifications on the ECL. Is it given that the probability of loss given default anecdotally is I presume low, is it fair to assume that going forward provision costs on a recurring basis will be structurally lower?
See, yes, that is what it looks like right now, that after the implementation of the Ind AS, the way we used to look at NPLs earlier and make a provision based on a rule-based formula, irrespective of the underlying securities, irrespective of the asset coverage ratio, and irrespective of the ultimate recoverability experience. So those were never taken into account. Now, these things are taken into account. The security value, the number of times of security cover, as well as our own experience and the track record in recoverability. So all these things are taken into consideration, and as a result of which we have seen the provisioning levels, that is called the loss provisioning levels under the ECL, that has been coming down.
And given that, Sudipto, I would imagine that the whole idea is to move from a rule-based, prescriptive kind of system to one that is more realistic and is more driven by past experience, actual real experience of the concerned company. In that case, is there a reason to be more conservative? Because the idea is to not, as I see it, is not to be more conservative or more aggressive, but to be more realistic.
More realistic.
And so, in that, I am just thinking, you mentioned a while back that you were conservative in terms of your provisioning on the stage 3 thing. So I'm just trying to understand that from that point of view.
Yeah, actually, if you look at it historically, the loss rates has been around 7 basis points. In our 29-30 years of operation, the loss rates have been in the range of around 7%. Obviously, historical loss rates need not necessarily always play out in the future, and that is the reason why an extra buffer or an extra provisioning has been maintained in order to ensure that the conservatism is not dispensed with.
Mm-hmm. Because if you just go by past, anecdotal, like you mentioned, 7 basis points, then obviously the need for provisioning should come down significantly even from the levels that you've currently maintained. Is that fair?
Yeah, I think, that is the reason why I mentioned that there has been some conservatism which has been built in there. And you can actually probably now visualize that in the earlier NPA recognition and provisioning formula, it was much too conservative.
Thanks, Aditya. That's it.
Thank you. We take the next question from the line of Sunil Tirumalai from Credit Suisse. Please go ahead.
Hi, thank you very much. Couple of questions. Anything that helped the OPEX to fall? Just wanted to understand what is a sustainable number there.
The OPEX, actually, there are two parts of it. One is the salary and benefits, and the other is the establishment expense. Now, in the establishment expense, typically, we used to classify the commission paid to agents for acquiring the business. Now, that has to be apportioned. That cannot be shown as a charge-off item in the year of incurring the cost. So there will be a little bit of, I would say, aberration if you compare it with the numbers that were earlier being shown. Because now that item, which is one of the largest items, that has to be apportioned. So that is one of the reasons why probably you are seeing a steep fall. But going forward, that is going to be the accounting practice.
Yeah, so my question was more from, on slide 14, I'm guessing both the previous year and current year numbers are on the same accounting.
Correct.
Even there also we've seen a decline.
Yeah, that is because probably in the current quarter, the component of commission would have been much larger than the component of commission in Q1 of last year. So as a result of it, both have been removed from the basis. That is one thing. Second thing, in the salary and benefit part of it, there was a one-off item which was charged in Q1 of last year, which was one installment of an arrear payment, wage payment, which has obviously not been there in this year.
Can you quantify that, please?
Around 7 crores or so.
Okay. And got it. And secondly, just wanted to understand how are you thinking about growth rates long term? We actually have not just companies smaller than you, but even the company which is larger than you, the market leader, also in individual loans delivering 18-20% kind of growth rates. Is that something that you are you're kind of planning to do, or what? It's that in your aspiration, or are you comfortable with sub 10% kind of growth in home loans? I just wanted to get your color on that.
No, Sunil, as I said, we are targeting growth rates in excess of 17-18%, so that we land up somewhere near 15% or so in the coming quarters, and that should start happening starting Q2.
Got it. And final question is, any change in your funding strategy, funding mix, given the new interest rate regime, that will be helpful. Thank you.
Yeah, actually in the funding strategy, we have been doing, I would say, slightly more levels of commercial paper within our ALM framework to ensure that, we get the best of the funding cost. We have also very recently, put a lot of focus in raising the public deposits, the retail deposits. So we have revamped the entire scheme with slightly more attractive rates, and probably we'll be a little bit more aggressive in raising deposits going forward. We are also actively exploring external commercial borrowings, and we've already been discussing with several banks for ECBs. That has also been happening parallelly.
Got it. Thank you and all the best.
Thank you. Thank you.
Thank you. We take the next question from the line of Bunty Chawla from B&K Securities. Please go ahead.
Thank you, sir. Thank you for giving this opportunity. Just need the data points. Can you share the incremental yield and incremental cost for cost of funds?
Incremental cost of fund for the quarter, it is around 7.89%, and incremental yield is slightly more than 10%.
So what will be the yields, incremental yields, if we compare with the Q1Q basis? You said it has increased, and this quarter it was around 1.9%.
No, that is you are talking of the back book spread. No, back book spread is 1.9%.
Okay, so incremental spread should be?
Incremental spread should be, as I told you, 7.89 was the incremental cost of fund, and right. The annualized yield should be around in the range of around 10.19 or thereabouts.
10.2 roughly, I can say.
Yeah.
Okay, sir. Okay, sir. Thank you very much, sir.
Thank you. We take the next question from the line of Adarsh from Nomura. Please go ahead.
Hi, sir. Question again on cost of funds. You did mention 7.9% incremental spreads. 7.9% incremental cost of funds. That includes a lot of CP, right? That's not like a sustainable funding strategy, right? So where is your, current cost of funds on the full book? And if you have a judicious mix of, say, loans, bonds, and some CP, what would be your incremental cost today?
See, actually, I wouldn't say that the level of CP is very high, because as of the quarter end, the CP is only constituted about 6.7% or 7% of the total liabilities. So I wouldn't say that it is very high. It has been, it is higher than what we used to have maybe a couple of years back, but it is still much less than as comparable to peers in the industry. So it is well below 10% in terms of the total exposure to CPs as we had on 30th of June. So that is number one. Number two is that, yes, there has been an increase in cost, but when you actually look at the cost, you will also have to see the fact that there are liabilities on the book which are also maturing. Say, for example, in this current year, about 20,000 crores will be maturing, which were pegged at around 8.5%. So if I replace the same amount at as present, it looks like slightly lower than that. There will be some marginal benefit that we will get on the overall cost of liabilities, and the cost of liabilities also will be looked into, and at the same time as that of the asset repricing. So there has been an increase in the system cost of funds in the interest rate scenario, and we have passed on the interest rate hikes also on the asset side, and commensurate the effort is to always ensure that the margins and the spreads are protected, which we have been able to display in the first quarter.
So broadly, the way to look at this is your whatever repricing you're having on liabilities, you will be able to reprice it broadly as of today at the same rate. Yeah. And then you're looking at assets where you would have like a 30-35 basis point advantage. So will that be a full spread benefit, or how should one look at it over the next 2 to 3 quarters?
Yeah, I think a majority of it will flow through. A majority of it will flow through to the bottom line, because as we just mentioned, the cost of funds we have been able to hold at the same level as that of March, considering the fact that there have been 2 rate hikes and there has been at least a significant increase in the system cost of funds on the incremental side. That has happened because of kind of changing the incremental liability structure to some extent, and majority because a large portion of our liabilities are of fixed cost, which locks in the cost at that particular level. So there are no further increases. So the benefit flows from the asset side directly to the bottom line.
And second question, again, coming back to asset quality, right? We've discussed there is seasonality in individual loans, but there has been some increase. So which segments have you seen the increase? Geography, individual book, LRD, LAP? Because you kind of give the NP on individual, but that includes home loans, core home loans, then it includes LAP, LRD. So if you can just break that up, how many accounts? Because the point is, in the last 7-8 quarters, we've seen about a 10% increase in our non-core book mix. I just want to make sure that, we are not looking at an ever-increasing trend, because that's, we've seen that in a few HFCs. So, yeah.
No, I think if you look at the overall category-wise between the LAP, the LRD, and the normal core home loans, of course, builder loans, you are already having the figures, so we are not discussing that separately.
Correct, yeah.
Obviously, the LRD delinquency rates are the lowest.
Okay.
But between the LAP and the home loans, I would say it is more or less at par. Probably the LAP is slightly higher, but it is not drastically higher as compared to the home loans.
So, any specific reason or geography you can think why, I know it's 20-30 basis points, but I think for a company where your credit cost annually has been 7-8 basis points, 20 seems a lot. So if you can just, any reason, like I'm sure you would have, got into which accounts, which geographies, or which income segment of, guys have kind of led to this higher default rate. So if you can just, qualitatively talk about that.
No, geography-wise, if we see, North continues to have high NPAs, and South also continues to have high NPAs. East contributed a lot last year, but that's on a recovery trail. Their recoveries are better. They have been reducing their NPAs. As far as accounts are seen, it is the sub 15 lakh ticket size where it's more. In LAP, of course, whatever we have seen is there also some higher cases are there, but LAP also, our average ticket size is not very high. But as compared to these 18 lakh ticket size of 15 and less, LAP is slightly more.
Understood. Sir, last question. Can you just, I kind of joined a little late. I don't know if you discussed this. Can you walk us through your net worth reconciliation under Ind AS?
Yeah, that is one thing, that the net worth increase will be almost to the tune of slightly more than 1,000 crores. So it is almost 10% increase in the net worth that would have happened.
Can you give components, Sudipto, of this? Like, I'm sure deferred tax is one, but apart from that?
It is majority of it is DTL only.
And did ECL lead to a reduction or an improvement? It should have led to a reduction, right? What was the quantum?
It has led to a reduction.
How large was that?
See, the ECL reduction is actually not fully factored into the balance sheet. That's something that we will probably in the next quarter will be able to get more light on it. We'll be able to share more light on it. But the difference could be as high as 200 to 250 crores.
So you're saying that as of today, you've not factored ECL and it's 1,000 crore improvement, but you could have an ECL hit of 200 to 50 crores? Is that the way to look at it?
Please. Positive impact.
Positive impact. Okay. Understood. Perfect. Thanks a lot for this.
Thank you. We take the next question from the line of Amang Shah from HSBC Mutual Fund. Please go ahead.
Yeah, hi. Thanks for the opportunity. All my questions have been answered. Just a clarification on Adarsh's question. So you meant that 1,000 crore accretion is largely because of DTL, and assuming next quarter when the ECL adjustment happens, there could be a positive impact of 200 to 250 crores.
Likely, yes.
And that is over and above this 1,000 crores?
Yeah.
Okay. All right. Thanks and all the best.
Thank you. We take the next question from the line of Ash Desai from Vallum Capital. Please go ahead.
Yeah, my question was with regards to the 50 basis points hike in the PLR. Don't you believe that with this 50 basis points hike in PLR, you'd start losing some of your books to balance transfers to, some of these banks who've been able to maintain their housing finance yields at a much lower level?
No, I'll say two things to that. One is we have done it after seeing the competition. So it's not that our rates are very high and there's a very low. They maybe, as I mentioned earlier, also it's a 5 basis points difference with one of the banks. That's all. And number two, as you will see from the Q1 numbers, and we are working on it. Our exits have gone down actually. Okay. We have seen a marginal reduction in that.
Okay. No, my point of view was more like, as you said, across the board, competition have increased their marginal lending rates, but as a matter of fact, a lot of housing book would start moving from housing finance companies to banks, as we were told by a couple of other housing finance companies. Do you see a scenario like that happening?
No, I don't think that can be a given, that housing finance companies will lose portfolio to banks. I think that cannot be taken as a given. It probably depends on many factors, including the servicing, the rate of interest being offered by the HFC and the bank. So I don't think that can be a straight cut formula that HFCs are going to lose market share to banks. Actually, in the last couple of years, the contrary has been the case.
Yes, that's in a falling interest rate scenario, but I thought,
No, it does not. Actually, if you look at it, it is not that way, because I think at least for the top few HFCs, they are as competitive as the top few banks.
Okay. All right.
In terms of their ability to retain customers, acquire customers, as well as also to borrow funds at the lowest possible rates.
Okay. All right. Thanks a lot.
Thank you. We take the next question from the line of Manish Agarwal from PhillipCapital. Please go ahead.
Yeah, thanks for the opportunity. Just one data keeping question. What would be our weighted average yield on individual loan as well as the incremental yield on the individual loan, excluding your LAP and builder portfolio?
The individual lending will be, in the home loan side, will be around 9.2%, whereas on the, this is the annualized, whereas in the LAP, it will be around 10.5%.
And on the weighted average basis, what would be individual yield?
Individual yield on the weighted average basis will be around, you're talking of the ex-LAP or with LAP?
No, without LAP.
Without LAP, it will be around 9.4 or thereabouts.
So basically your back book and the incremental is more or less same now, correct?
Yeah, now it has been more or less same because of the repricings which have happened on both the sides.
Fine. Thanks. That's on side. Thank you.
Thank you. We take the next question from the line of Kushan Pati from MK Global. Please go ahead.
Yeah, hi, sir. Am I audible?
Yeah,
hi, this is Signesh here. I just had one, all of my questions have been answered. Just one simple thing. When we're saying stage 3...
excuse me, sir. This is the operator. I'm so sorry to interrupt. Can I please request you to use the handset mode, as your audio is not very loud?
Yeah, I'm the handset. Now, is it better?
Slightly better. You may please proceed. Thank you.
Yeah, so I just had one question. This your June 18 stage 3 NPAs, which is 1.21%, is all your 90 days recognition NPA, right? There is the definition of NPA remains the same what it had been in the previous term. I mean, as per the RBI, right?
Yeah, stage 3 is more than 90 days.
All are 90 days plus, and there is no stress asset or something like different. All are 90 days plus DPD1.
Yeah.
Yeah, perfect. That's it. Thanks a lot, sir.
Thank you. We take the next question from the line of Kamal Verma from CLSA. Please go ahead.
Hello?
Amal Verma, yes, your line is unmuted. Please go ahead.
Yes, I just wanted to ask regarding the provision levels under Ind AS. So for most of the housing finance companies, provisions have declined. For you, it has increased from like 1,000 crores, 100 crores in 1Q FY18 to 200 crores now. So this may be due to seasonality because you have higher NPLs in first quarter.
No, actually it is the other way around. Last year it was 204 crores. This year it is 160 crores.
Yeah, no, that's under Ind AS. I'm comparing between IGAP and Ind AS. So under IGAP, your provisions last year were 100 crores, 104 crores. Under Ind AS, it is 204 crores. So it has doubled. Yes. So what can be the realistic number for the full year?
The full year numbers will be more or less in line with the trend for the current Q1.
So like 160 crores.
Yeah. And progressively, if you look at it, generally the first quarter, the provisions are the highest because the NPLs are also the highest in the Q1. Progressively, Q2, 3 and 4, the NPL levels keep on coming down. So progressively, the incremental provision for each of these 3 quarters will be lower than what we've seen in Q1.
But it will be But it will be higher than what it would have been under IGAP.
Unlikely, because if you look at the entire ECL model, the overall provisioning itself has come down significantly. If you compare the on-book provision as of 31st of March, and if you compare the ECL provisioning as of now, that is what we were discussing in a couple of questions earlier, the gap is almost 300 crores positive.
Yeah, but still the provision costs are higher. So
no, actually it has come down. That is precisely what I'm telling you. The overall provisioning
it has come down. But I'm comparing between IGAP and Ind AS.
Between IGAP and Ind AS, the provisioning has actually come down.
Okay. Okay, and regarding like how much portion of your borrowings are fixed rate, at fixed rate?
Fixed rate borrowing will be around 75-77%.
Okay, and these are at 8.5% as you mentioned, I think.
No, I didn't mention that 8.5%. It is less than 8.5%. 8.5% is that portion of the borrowing which is going to be received during this current financial year.
Okay. And the total stock of borrowings would be at? These fixed rate ones?
Yeah, it will be less than 8%. Slightly more than 8%.
Okay.
Thank you. We take the next question from the line of Nishin Chavati from Kotak Securities. Please go ahead.
Hi. Just one thing. How much recovery did you make from the developer loan this quarter?
The developer, that account was total around 70 crores, which we have recovered, out of which about 40 crores was the principal quantum.
Sure. And then in terms of accounting, this 30 crores will be reflected, the balance 30 crores will be reflected in interest income?
No, it will actually not be in the interest income for the current financial year or current financial quarter, because under Ind AS it will not be in the one quarter.
Okay. So, sorry, then how does it get accounted for?
See, under Ind AS, even for a loan under which is under EAD, you can still accrue interest on EAD stage 1, 2 as well as stage 3. So when you are actually accruing the interest on any of the stage 1, 2 and 3, even if there is a further recovery after some time, the full lump sum comes back after some time, you cannot count it back again.
Okay.
What you are referring to under Indian GAAP is correct.
So will it mean that this feeds into will it mean that the provision for the quarter was less, or it just feeds into lower, how does it really get accounted for?
See, the provision release will be there. To the extent it was already been carrying on the books as per the earlier accounting standards.
Okay, so I believe this was 100% provided, so to that extent you almost got it?
Yes.
So to that extent you got a 30 crore saving this quarter?
Yeah.
Okay, sure. The other point that you mentioned was that other expenses, I think there was some adjustment with respect to origination expenses. Is that right?
Yes.
So the origination expenses now on will be deferred?
It will be apportioned, yeah.
it will be apportioned, and this apportionment happens at the expense levels, not at the income level.
It happens on the income levels also to the for the component of processing fees, which is collected at the time of originating the loan.
Okay, and what gets apportioned at the expense level?
It is the commission expenses.
Okay, commission expenses as in the DSA commissions, you mean?
Agent's commission.
Agent's commission, that's right. Just one small data reconciliation. Your non-core book was 27,000 crores, right, at the end of the quarter?
Yeah, yes.
And last year's, not last year, fourth quarter was 23,800 crores?
Yes.
And the disbursement for the quarter was around 1,400 crores?
1,400 crores?
How much was the disbursement in this segment?
1,400, yeah.
So if I do 23,800 plus 1,400, I get around 25,200. So how was the closing book 27,000?
See, there is actually some LRDs which were not classified earlier is now being categorized under this segment.
Okay. So just curious, just for record sake, what could be the loan book like on a like-to-like basis? 23,800 could have gone like where?
Sorry?
This 23,800, this quarter should have been like what number? I believe 27 has some regrouping, so.
Yeah, it could have been around, say, 2,000 crores lesser.
Okay, sure, great. Thank you very much and all the best.
Yeah.
Thank you. We take the next question from the line of Amit Goenka from Rare Enterprise. Please go ahead.
Hello, sir. Hello.
Yeah.
Hello, sir. Sir, this is Shant. Sir, my question has been answered. Thank you, sir.
Right.
Yeah, okay.
Thank you. We take the next question from the line of Subramaniam Iyer from Morgan Stanley. Please go ahead.
Hello.
Please go ahead, Ms. Iyer. Mr. Subramaniam Iyer, your line is unmuted. You may please go ahead with your question.
Hello. Sorry. So a question on your margins. So as I understand, under India, the seasonality in your margins should be lower because you would be accruing interest income on your NPLs as well. So does this mean that this quarter seasonally shouldn't have seen the kind of decline in margins that you see typically, and even the fourth quarter to that extent won't see the same amount of margins, benefit in margins even if you were to have interest income recoveries, even if you were to have NPL recoveries?
See, actually now the margin recovery will be driven. Obviously, whenever there is a significant upgrade in asset quality, it will have an impact in the provisioning and also in the classification of assets in the EAD 1, 2, 3 category. But mostly the margin recovery will be driven by improvement in the lending rates.
Got it. And a question on the deferred tax liability reversal. Does that, so how has the accounting been done from a tier 1 perspective, in the sense that were you knocking off, did your tier 1 suffer as a result of this deferred tax liability creation in the past, or so would you see, so essentially would you see a benefit to your tier 1 as well?
No, it was neutral. It was neutral to that, so it will not have any significant, it will not have a write-back impact.
Okay, sorry, can you explain how it was neutral actually?
It was neutral because it was not taken out of the tier 1.
Okay, got it. Thank you.
Thank you. We take the next question from the line of Manish Shukla from Citigroup. Please go ahead.
Yeah, good afternoon and thank you for the opportunity. Of the 20,000 crores of borrowing during quarter, how much would have been CPs of the incremental borrowing?
See, about 7,000 would be on the CPs.
Okay, and that you're saying is more or less quarter specific. It may not be same proportion through the year.
It is 90 days, 60 days between that. So sometimes what happens is the cumulative number might be 9,000, but actually it might be 2 CPs taken within the same quarter.
No, so I'm saying as a proportion of CPs, so 7,000 on 20,000 crores. Do you see the proportion of CPs remaining similar on incremental basis?
It will come down. See, always it cannot exceed the rating, which itself is quite low, number one. Number two is that at the end of the quarter also, if you see the total amount of CPs that we were already having as on 31st of March, plus the CPs that we have done incrementally during the quarter, the total itself is, the June end number itself is much lower than this, the addition of these two.
That's the reason I asked on an incremental basis.
Yeah.
Sure. The second question is, what is the total non-core disbursements for the quarter as a non-mortgage disbursement?
Project included, you're asking?
No, project separate, on the individual side. Project we know.
1,400 crores.
1,400 crores is all non-core. Okay, so the LRD, the roughly 2,000 crore adjustment that you're saying was earlier classified under project or individual?
The part of it was under project.
Okay. Fair point. Okay, all right. Those were my questions. Thank you.
Thank you. We take the next question from the line of Nikhil Valecha from JM Financial. Please go ahead.
Yeah, hi, sir. Could you please tell me the exact number for net worth as of June 18? Is it 13,700 crore?
Yes, there has been an increase of, to be very honest, the balance sheet figures are to be disclosed only as of September. That is the publication of balance sheet has to happen in September. But the increase in the net worth, which has happened on the opening balance sheet of 1/4/2017, as per the Ind AS, the increase in the net worth is to the tune of around roughly between 11 and 1,200 crores.
So this would be around 12,500 crore to 13,000 crore.
12,500 crores was the closing net worth as on 31st of March 2018.
Yes. So, I mean, the 1,000 crore number that you are saying, that would be added on March 18 or Q1 18 number?
No, it will be added as on opening balance sheet, always.
Okay, so this would be around 13,500 then?
Yeah.
Okay, and sir, what is the exact amount for this DTL?
DTL would be around, say, roughly around 11 to 1,200 crores.
So this increase in net worth is primarily on account of DTL, right? 1,100 to 1,200 crores.
Yeah.
Okay, sir. Thanks.
Thank you. We will take the last question from the line of Qtr1 from Reliance Nippon Life Insurance. Please go ahead. Qtr, your line is unmuted. Please go ahead with your question.
Hello. Am I audible now?
Yes.
Yeah. Thank you for the opportunity. I just had a data point question. So I just wanted to understand what is our split between the individual loans and the remaining part of our total AUM.
Achha. On the total AUM,
yeah,
the individual plus LAP put together will be around 95%. 5% will be the builder loans.
Okay. And on the individual loans, we are seeing that we have a gross NPA of 0.81%, and overall we have about 1.2%.
That's right.
Is that right? Yeah.
Yes.
That was my question. Thank you.
Thank you. Well, that seemed to be the last question for today. I would now like to hand the conference over to the management for their closing comments.
Yeah, thank you for the queries. We have with the company, again, as I said, is again going ahead and seeing to it that we get back to more than 15% growth in disbursements. We arrest the NPAs and bring them substantially down by Q2. Improve upon the spreads and see how best we can borrow funds at the least rates available in the market. Thank you very much.